Hello, Assalamualaikum warahmatullahi wabarakatuh. My name is Harith Zafran bin Zulraidi. My metric number is 261040. And today I would like to share about the issues in earning management. So, what is earning management? Management is the use of accounting techniques to produce financial statements that present an overly positive view of a company's business activities and financial position. It's like an advantage of how accounting rules are applied and create financial statements that inflate or smooth earnings. Is it good or bad when they use the earning management? It has a two perspective here, which is the good one, where they're reasonable and legal, and when the managers intended to achieve stable and predictable financial statement. For example, it gives the manager flexibility to act when something unexpected happens. For example, they can increase their net income to give a bonus for the employer as a motivation and as a to motivate them as a reward for them for their hard work. And the next one also to maintain their good reputation of the CEOs and the company. And the next one is the bad side. It can be bad when it reduces reliability, especially in the financial statement, and also it will mislead some stakeholders. For example, when they try to decrease the net income to avoid uh, tax liability, usually they are doing that, and also they will try to increase their asset just to attract potential investor. And the next one is the method of earning management. Okay, for the method, I will it has four methods. The first one is taking a bath, the second one is income minimization, the third one is income smoothing and income maximization. So I will separate these two between the taking a bath and income minimization because taking there has a similarity there. For the taking a bath, if company must report a loss, they will report a large one, which is they will write off the assets to enhance the probability of future reported profit. However, why income minimization is similar to taking a bath, but you will write off asset, expensing, advertising, and R&D, and also for politically visible firms during period of high profitability, which is when it happened, such as when a company report a loss, they will usually make a target for the next year. I mean, for the forecasting. So for the next year or for the next 2 years, they won't put a high target for that. They will put a lower or maybe just to improve from their current loss. So they won't. So it won't put a pressure for the company and for the employees to work harder. So the next one is income smoothing and income maximization. For the income maximization, it's usually used for a bonus purposes. As I said before, they would increase the net income and to give the bonus for the employee and also to violate that covenant. And when the net income is between bogey and cap, and also it use the accounting policies and procedures that can increase an income. For the income smoothing, it's similar to income maximization, but they will try to sustain the income between bogey and cap to for the violate that covenants and to reduce volatility of reported net income by using general accepted accounting principle and also to maintain a good reputation of management and CEO. As I said before, it can be good and also it can be bad. So here is the main issues that I would like to stress about, which is the first one is ethicality of earning management and the inaccurate of the financial statement. So the first one is accountability of managers and ethical obligation in earning reporting. So we will talk about the ethics here. For the ethical accountability of managers, the companies are often governed by their managers for the benefit of the managers itself rather than in the interest of their shareholders. This is according to the scholar Benbridge and Johnson, which means sometimes some manager will act on their interest itself, not from their shareholders, not from an advice from the shareholders. So maybe it might be like it's either they are doing a legal way or it's either they are using that illegal way. And the next one is a report from the American Committee of Sponsoring Organization that declare from the 1981 report declare that the Kohlberg's theory of model reasoning, 72% of the fraud incidents observed, the executive manager appeared to be linked to the fraud and dominate the firm's board of directors. And the next one is the ethical obligation earnings reporting. So according to the Haley and Wahler, there is some understanding that earning management involves distortion in applying gap. In this way, they undermining the morality of the practices. So it means like since the scandal of the Enron for the past decades, the media and the business analysts have has attracted to attention on quality information and reporting integrity. So they're really concerned about the integrity of the firm and of the company. The next one is the focus of capital markets on regular profit growth and the fact that lending institutions require a company to show credit stability to maintain its debt in good standing are two such dilemmas. So, is it the bad or good in ethics? The ethics is ethicality of earning management is bad when they hide the operating performance and mislead the financial statement, as I said it before. And it is good when they manage effectively and create a value for the shareholder. So, such as they increase the shares, they increase the bonus in that year. So they attract the investor, but in a legal way. And the next one is earning management and fraud. There's a slightly different between that because most people thought that earning management is a fraud and it's a fraud itself. So there's a difference. Earning management legal act within generally accepted accounting principle, while the fraud is illegal act that already violate the GAAP. So in these cases, that's why most managers or most CEO they tend to do the earning management for their own benefits rather than fraud because fraud is clearly is a illegal act. So the next issue is inaccurate financial statement. First one is companies sometimes commit fraud in their financial statement that mispresenting companies' financial health to impress investors or hide taxable income. As I said it before, they will try everything, right? And the next one is the reports lack comparative data showing, like the material misstatement there, and their information, lack of transparency, and the last one is it will affect the decision making negatively for the company. They can't make a really good decision. It's either to invest in this thing or not because they don't know the exactly figure of their reporting, so they could not make a wise decision. And for example, other than Enron cases, I will take a WorldCom here. WorldCom last time after the Enron cases, there are scandal with a WorldCom where the WorldCom asset look very solid that they have 104 billion and debt to equity with a 79.3%, which is a very good. But however, half of the assets are consist of goodwill and other intangibles. It means like they don't really have a tangible assets, which is very fragile. And the next one is they announced that they have 3.8 billion in accounting error, which is they capitalizing the line cost fee to other telecom companies for network access right. These are operating expense. So which is they are usually do it at error. They have a lot of material misstatement. That's why they have a lot of asset. And Welcome their filed for bankruptcy in July in 2002, replacing Enron as the largest bankruptcy in US history. Yeah, the Enron is in 2001 and the WorldCom is in 2002. The last one is the consequences. The consequences of the inaccurate financial statement is wasting time. Because the financial department need to spend hours or maybe days or maybe a week just to reconcile the financial data. So they need to check it again, check the filing, check the documentation, and all. And the next one is it also harder to make good decision, as I said it before, because the company rely on financial data in budgeting, forecasting, and developing performance indicator. So it will take a long time for them to make a good decision, to make a wise decision, because the lack of data, the lack of confirmation of their reporting itself, of their financial report. And last one, that's all from me. Thank you. Assalamualaikum.